Welcome everyone to our panel on business, taxation, and society. I am Juan Carlos Suarez Serrato. I am a professor of economics at the GSB, and I'm a co-director of the Stanford Initiative for Business, Taxation, and Society, or STAX. At STAX, we aim to bring together perspectives from accounting, finance, and economics, and to foster conversations between business leaders, policymakers, and academics, exactly what we're going to do here today. I'm joined by my co-moderator, Rebecca Lester, an associate professor of accounting, who's also the co-director of STAX and an expert in corporate taxation. It's always a pleasure to co-teach our class on taxes and business strategy. Becky brings a lot of expertise to the topic, as well as a knack for making complex topics approachable and engaging. We're really fortunate to have an outstanding panel of experts in tax that combine insights from the business world, government, and from the policy world. George Callas is the founder of Callas Strategy Group. He previously served as Executive Vice President for Public Finance at Arnold Ventures and spent over 15 years on Capitol Hill, including as Senior Tax Counsel for the House Ways and Means Committee and to Speaker Paul Ryan. Gaurav Nagdev is head of tax at Webflow. He has over 15 years of experience across companies like Oracle, SanDisk, and Viva, with expertise spanning in tax strategy, M&A, and financial reporting. Elena Patel is co-director of the Urban-Brookings Tax Policy Center and a senior fellow at Brookings. Her research focuses on how tax policy and social programs shape investment, labor markets, and economic security. In a minute, I'll turn it over to Becky to lead the discussion, but first I'd like to ask each of our panelists to briefly share their perspective on what they think are the most important features of the tax landscape today, and what are the most important policy conversations they see on their day-to-day work. So Elena, why don't you get us started?
Yeah, sounds good. Thank you guys. It's great to be here on this panel with everybody. From my perspective, the moment that we're in tax is very much intertwined with the federal fiscal picture. And so those two things are related to each other, and the fiscal moment that we face right now is really a consequence of a series of tax bills that have been passed, extended, and permanently extended since 2001. And so where we are right now is a place where federal revenue is structurally lower. And so we used to be at a place where federal revenue was more like 19% of GDP. It's now more like 17% of GDP, so we're bringing in less revenue per GDP dollar than we were in past moments, but not at a time when we're also shrinking spending. And so the result of that is we've got this structural budget gap, which has persistent primary deficits that are 2% of GDP right now, and we're going to go to 3% by the end of the 10-year window. And if you think that some of the temporary pieces of the bill that was passed last summer, so these are the populist provisions like no tax on tips, no tax on overtime, temporary increases in the state and local sales tax deduction, if those are extended, that primary deficit increases to 3.5%. So that just means we have a structural imbalance between revenue and spending that will have to be resolved. That feeds back into our debt to GDP ratio, which is very much the underlying dynamic of Washington, D.C. right now, because it means there's not a lot of fiscal space to have conversations about new spending programs when we really don't have the fiscal space to spend on what we are currently spending on. So debt to GDP right now is about 100%. And for context, that's a historic high if you ignore one period where it was a little bit higher during World War II when we were funding the war effort. So we're at 100% right now. By 2054, if we do nothing, before we had passed the tax bill last summer, that would have grown to 154%. So 100% is already a high. We were going to go to 154. With the tax bill that passed last summer, the estimates are that will grow to 183% of GDP. If we extend some of those temporary things I talked about, it'll grow to 200% of GDP. And then if we make one small relaxation in the assumptions that underlie these trajectories, which is there might be some interest rate feedback that comes from the fact that the government is deficit financing its spending, which crowds out private investment. So if you allow for that feedback, these projections go to 233% of GDP. So we're like way outside historical norms for the US especially, but even around the world. And from the seat that I sit in, that dominates the tax conversation because tax is the primary way that we raise revenue. One other scale point to make that I think is really important, the tax bill that was passed last summer, it cost about $4 trillion. Again, it was deficit financed. We could have used the same resources to shore up Social Security for 75 years. And so I want to make the point that what we decided to do last summer in Congress was a policy choice to address expiring tax cuts as opposed to dealing with Social Security. And so this is really the next tax moment on the table because the Social Security Trust Fund is financed by payroll taxes. And so this is projected to be out of funds and paying less than 100% of eligible benefits in 2031. So it's now pretty close. It's in the political window, which suggests if it's not a topic of a conversation for the midterms, given what's going on right now, it very well may not be. By the next presidential cycle, Social Security is going to have to be part of the campaigning. And so that to me is the tax landscape on a going forward basis. We had a regressive tax bill that was passed last summer that made our fiscal trajectory worse and not better. And the question is sort of what is the next like cliff or moment at which we might politically decide is the time to resolve it.
First off, happy tax day, everybody. Hope you guys filed on time. So I'll speak on the landscape more from just kind of an operational perspective, where we're feeling it in industry, like in my company, Webflow. I think two terms. One, globalization, right? You've seen now a global coordinated system come up, Pillar 2, that's now imposed a 15% minimum tax, right? The second piece is all these governments are now sharing information and data. So tax is not hidden anymore. It's out there. The second thing is transparency, excuse me. You have more visibility, more data, more information, more reporting, yay for us, more filings. So now everything you've done is out there. So think about the new accounting standard that's come out. You now have to disclose your effective tax rate by jurisdiction and taxes paid. You're basically handing the world your tax profile. So let's play an example. You have country A, you have country B. If I pay $1 million to country A and I only pay 500,000 or 200,000, let's say, for country B is going to ask, why is that happening? What can I do to figure out why is this kind of an unfair imbalance is probably the best way to use it. So that's where we're feeling the landscape from an operational perspective. And I think that transparency piece is going to continue to grow. I think there's just going to be way more information that we're going to continue to have to share across the board.
All right, my turn.
Your turn, you got it.
Well, I'm going to touch on the topics you both just talked about, and then add maybe one or two things. First, I would say, I largely second everything that Elena said about the fiscal situation and this question of like, well, why do we care? These are just big percentages and big numbers. I think we are. I recommend Ray Dalio's book, The Big Debt Cycle, where he talks about how he's predicting that we kind of go through these 80-year cycles, and every 80 years you have a big debt crisis. And he thinks we're about 70 to 75 years into a cycle. And he presents all this information as to why his model calculates that. I think it's a pretty compelling case. I can't guarantee he's right, but I think it's a pretty compelling case, compelling enough that we ought to be really worried about it, that we're getting to a point where the debt spiral we're in, where the debt is getting so large that we have to keep borrowing more money, keep dedicating more of our tax revenue, and keep borrowing more money just to meet our debt service costs. Right, debt service costs now for the federal government are over $1 trillion, more than the defense budget, and that creates a vicious spiral where the more you borrow, the riskier of a borrower you are. So you have to pay higher interest rates. Higher interest rates require you to borrow more, and on and on and on. At a certain point, you get into this sort of inescapable death spiral, and the concern is we're getting close to that tipping point. I think we could all sit here and talk about this and still not emphasize it enough, the risks that are involved in this. And so what happens? Well, at some point, either if you don't fix it, if you don't get to a sustainable level of borrowing, you either default on the debt or your central bank starts monetizing the debt so you can pay it back in cheaper dollars, which is basically kind of a backdoor default, right? And so, I think dealing with that is going to require work on both the tax and the spending side to get to a sustainable level. One side of the ledger or the other cannot bear the full burden of what it takes to get to sustainability. That's not ideology. I mean, Elena and I, when we were in public service, worked on different sides of the political aisle. That's just math, right? It's not liberal, conservative. It's just pure math. So that's a deep concern and something I'm paying a lot of attention to right now. And then the kind of the multilateral environment is something else I'm paying attention to right now. You know, the United States cut a deal with the OECD to kind of bless our international system and our version of a foreign minimum tax to make sure multinationals are paying a certain amount of taxes. The problem is the OECD is not a parliament, right? It's a powerless organization at the end of the day. And so even though we have a deal with the OECD, it's not really a deal until national governments around the world implement the deal in their legislation, saying, okay, we're not going to go after US companies as long as they comply with this deal with the OECD. That very much remains to be seen. And so it's also something to continue monitoring. Two other quick things. One is, you know, I'm a tax person. We're all tax people to some extent up here, to a large extent up here. I'm having to learn a lot about trade these days. And, you know, I even made the mistake a minute ago. I said the tax side of the ledger and the spending side of the ledger. Well, in recent years, something we haven't seen since, you know, the McKinley administration, tariffs have become a material component of our revenue base and of the federal budget. And so it's probably better to say revenues and spending, not taxes and spending, because now whether you like it or not, tariffs are here and probably at some fairly highly elevated level compared to, say, 10 years ago, here to stay. I've heard people say, you know, like it'd actually be hard for the Democrats to come into power and just get rid of all the tariffs. So for various reasons. And so we now have to think about that. And a real quick story, if I have a minute. When I was working for Speaker Ryan in 2017 and Trump won his first term and started talking about all these tariffs he wanted to impose, we had to go do some research to see what power he actually had, and quickly discovered to our horror that back in the 60s and 70s, Congress passed a bunch of laws giving away their tariff power to the president. And so now not only do you have this other source of revenue that's significant, but it's one that can be changed on a daily basis without any action by Congress. And so the instability and the unpredictability of that one person can just decide on a daily basis based on their mood, whoever the president is, right? When a precedent is set that you have a certain power, you better believe that future presidents are not just going to give up that power. They're going to use that power as well. And so trying to figure out, as in viewing the tax landscape, trying to figure out how tariff policy going forward is going to interact with tax policy is a big challenge and something that requires quite a bit of time.
Great. Thank you all for the opening comments. So I'm going to ask a few questions. We'll have some time at the end for Q&A. But I want to hit on a thread that you are all kind of commenting on, which is that, you know, spending is our spending is growing, our obligations are growing. Tax revenue is not keeping up with that. We're turning to other sources like tariffs to help fill that wedge or that gap in between. And so what we're seeing now is kind of popping up a lot of discussions about minimum taxes, like for making sure a person, some type of people or some group of companies are paying some minimum taxes. And that came up a little bit when you're referring to like the Pillar 2, the global minimum tax. We all sit here in California and certainly hear about the billionaire tax, which is a minimum tax or some type of wealth. It's a wealth tax on, you know, wealthy individuals. And so I want to have a bit of a discussion about minimum taxes and how we think about them as a policy goal to basically close this wedge, right? Or to think about trying to address this wedge. So I talked about California's billionaire tax. It builds on France's wealth tax idea. The U.S. has a federal corporate alternative minimum tax that was passed in 2022 in the Biden administration. And then the OECD, of course, has the global minimum tax that has been adopted by many countries. So actually, George, I want to go to you first on this question. How do you think about minimum taxes as like addressing the problem or helping to generate some revenue? And, you know, you were really one of the key architects of the 2017 Trump, you know, change. So how did you all think about minimum taxes maybe at that point in time, or how do you think about them now as they're being used?
I mean, as far as the principles of good tax policy go, they're suboptimal. Because if you're needing to impose a minimum tax layering it into your regular tax system, that means your regular tax system isn't designed the way you want it to be designed. And so, you know, the optimal situation is to fix your regular tax system. If there are loopholes, plug the loopholes. Mm-hmm. You know, if the rate's too low, deal with that. You know, if you're giving out too many tax credits, just scale back the tax credits. But because of politics, and it's a real interesting political economy case study, it is politically difficult to do that often, and it is actually easier, and I think it's easier because it's more opaque. A principle of good tax policy is transparency, but I've actually kind of learned over the years that because of politics, sometimes if you want to fix policy problems, you have to do it in a non-transparent way. And so minimum tax, you know, Congress giveth and Congress taketh away. It giveth in the regular tax code, they taketh away with a minimum tax. And a good example of that is the corporate alternative minimum tax, the CAMT, which was enacted in 2022 as part of the Inflation Reduction Act. Nobody's really sure what it taxes. It's 15% of something, and nobody can really figure out what, because it's this sort of Frankenstein's monster that involves all these political compromises. But, you know, Joe Biden, Elizabeth Warren, others said, we want corporations to pay their fair share. And so we want to create this minimum tax to make sure they're paying at least this amount. Well, then they start moving this thing through Congress in the same piece of legislation that they're trying to deal with climate change by creating hundreds of billions of new dollars of corporate green energy tax credits. And they realize this new minimum tax that's going to make corporations pay their fair share is going to take away most of the green energy credits we're creating to deal with climate change. Right, and that kind of gives you a sense of like how kind of perverse it is to try to do things this way, rather than just figuring out what you want the tax system to look like. It's gotten so bad, by my count, you debate this, in just the Internal Revenue Code, the Federal Internal Revenue Code, I count at least 4 minimum or quasi-minimum taxes, and I would call it the CAMT, which we just talked about, the BEAT, the Base Erosion Anti-Abuse Tax, what's now called NICT, used to be called GILTI, which is our foreign minimum tax on the foreign earnings of U.S. multinationals. And then I would include in the TCJA, we did an 80% of income limit on NOLs, so that you can't use net operating losses from prior years to reduce your income to zero. That's kind of a proto-minimum tax, right? So we've layered in multiple minimum taxes as kind of a substitute for just having kind of a cleaner, more rational tax code.
Okay, that sounds definitely suboptimal. I want to think a little bit about the distributional then issues of that. So Elena, would love to hear your thoughts on this. So if the idea is that, you know, companies or some individuals may not be paying their fair share, which we're going to come back and talk about that in a bit, how we define that or how our panelists define that, and that there should be some minimum amount, then how does that actually impact the distribution? Because the idea is really like, there's some people who make too much. They're not paying their fair share or paying some amount. So how do you think about the distributional impacts of these minimum taxes?
Yeah, so George said that he and I often live on opposite sides of the aisle from each other, but I also hate CAMT. I just think it is such an example of politics having run amok with tax policy. So just to kind of layer on to what George said, CAMT itself arose from a political problem. And the political problem was that sometimes when you look at firms' financial statements, it looks like they're not paying any tax. The first thing I would say is nobody really knows what firms are paying in tax because that is private taxpayer information. Only the Treasury knows that. So people are kind of guessing, and probably guessing correctly, that companies like Amazon from time to time don't pay any tax. The thing that I like to say when people talk to me about that is, I think I said this in Juan Carlos's class yesterday, don't hate the player, hate the game. There's a really good reason why large companies from time to time don't pay tax. We build that into our tax code. It comes through things like large capital expenditures for which we allow accelerated depreciation and now full expensing, which will bring corporations, even that look profitable from a book perspective, down to a zero tax position. And so we've explicitly allowed the tax code to provide for that situation. So to go back at it, like George said, to then try to top it up with a minimum tax undoes the incentives that are built in the tax code that are more geared toward economic policy. The second thing is then they design the tax code to go after the Amazons. It doesn't catch the Amazons of the world. It is based on something that nobody knows what it is, AFSI, who knows, something about book tax, but it seems like it mostly just taxes timing differences between book and tax that all eventually reconcile over a 5 or a 10-year window. And it allows for all of the same things that tend to drive firms' tax rates to zero, like expensing, for example, or foreign tax credits in the old system. Those are all still allowed under CAMT. So it's not preventing a firm from going to a zero tax position because of a large capital expenditure. So it should raise a question to you, and I'm glad we're going to talk about fair tax later. What exactly is this thing designed to do besides to hit a talking point, which is we don't like it when it seems like large corporations aren't paying their fair share because in a particular year they have a low tax bill. And again, all I would say to bring it up again is this is by design. We are using the tax code to nudge firms to do certain things that we think are good for the economy, building factories, investing in R&D, all of these
Low-income
things.
housing.
Low-income housing is a big driver of low tax bills. We want firms to be doing that, so we shouldn't be trying to close it on the back end. If those were the policies we intended to be in place, it's just a recognition that sometimes that means firms will be in a low tax position. The political thing that's tricky about CAMT, from like a very nuts and bolts, I used to work at the Treasury Department and scores are very important. The sad thing is in the IRA, CAMT was scored as raising $200 billion, which I think was a wild overestimate. It's going to make it very expensive to pull it back because you have to fill what looks like a $200 billion hole. And I'll tell you that under the old CAMT, over a 10-year window, 10 years, on total, we only raised $50 billion in CAMT revenue. And that'll probably be true for this bill as well, and for this policy, that over a 10-year window where you get to carry forward your CAMT liability to next year to offset positive tax liability, I would say over a 10-year window, it's going to be more like $20 or $50 billion. But because that score is baked in, it makes it very expensive to unwind. So there's an extra political hurdle to get over to turn it off.
Okay, so in our class we talk a lot. We have several of our students in tax class here, so we talk about tax policy is all a function of the base and the rate, and so we've given certain provisions, right, exclusions from the base, whether it's something like depreciation or low-income housing credits, but then that doesn't, and so when companies claim it, then it drives down what it appears that they're paying. And so some of these minimum taxes are basically like, okay, well then let's increase the rate, but on a certain group of people and define a different base for them, and has introduced all of these problems that you all have put out. And I would say left and right side typically get behind the fact that, well, not everyone on the left, but that it generally is bad policy. I want to ask Gaurav this question, because you're running tax at a company and you're faced with trying to comply or think about this, both at a federal level, internationally. I mean, can you talk a little bit, you already spoke about transparency and reporting, all the things that you're having to keep up with. How do you think about minimum taxes as part of what you have to keep an eye on in terms of like, are you subject to these? Well, how do you think about these minimum taxes?
Yeah, I mean, first off, complexity-wise, no one knows what to do. Where to start, what does it mean? The guidance is still being refreshed and updated, so it's like when I talk to my CFO, we're not there yet at my company, but when I talk to him, it's like, I don't even know what I can tell you because it could change tomorrow, it could change globally, right? The Pillar 2's guidances are still being refreshed and updated, so it's hard to forecast. It's hard to really tell my CFO, when we get there, here's the taxes that we're going to probably have to pay and be subject to, because we really don't know where to start and what these definitions mean. So hopefully over time, guidance is clearer so that we can use this information to get better forecasting and planning. I would say some other challenges we face, Pillar 2 wise also, is you're running more data out of multiple systems. You're calculating tax twice for the same jurisdiction to see which one sticks, right? It just creates a lot more administrative burden for us, and I don't know, it's chaotic.
Yeah.
I would just add to that the initial version of the CAMT regulations weren't available till the end of 2018, and the tax bill was passed at the end of 2017.
Yeah.
So for an entire year, I think large corporations were
You
trying.
mean 22 and 23?
Oh, sorry. Yes, you're right. I didn't mean to pin it to the TCAJ, but like a whole year.
That was not me.
That was not George. It's your fault. It's yours. Not George. But it was a whole year after 2022 that the regulations even came out. So for a year, we heard, especially when you were sort of talking to the Treasury folks, that the complaints were from tax directors saying, we don't know what to do because we're being asked what's going to happen with CAMT, and there is not a single word of regulation for an entire year. And then it was only interim regulations; they weren't even finalized. So.
Well, this has been a very depressing conversation so far. So let's try to. I want to move in a very different direction, which is thinking about tax incentives for innovation. We can't have that discussion with we're sitting here in Silicon Valley, and want to think a little bit about how the tax code may support business creation, entrepreneurship, just generally any type of investing in some type of intangible. So Gaurav, I'd like to start with you. Like, how do you think about? I mean, increasingly a lot of valuation of firms, if you look at all of the firms, is on a function of their intangible assets, some high market to book ratios based on this kind of idea, ideas, growth opportunities, et cetera. How do you think that plays into opportunities for tax planning and what are types of, whether they're statutory incentives or jurisdictional incentives that companies think about when they're a high intangibles business, like the types where you're employed now and where you have been employed?
Yeah, so it's interesting. You think about the mindset of back in the day was get the lowest tax rate possible, and earnings mix is obviously one of the biggest drivers. Now you have a floor of 15%, so your planning opportunities have to be mindful, right? And I think with IP, where you create the value and where you report it, that's what you were talking about with like Amazon, right? Mm-hmm. Like people don't pay a lot of taxes because of this gap. And I think you guys can add more color on the policy side, trying to bridge that gap, right? Is why are companies so profitable paying little taxes because of this whole concept of IP? And what's interesting about now tax planning and strategies, it's not just about getting an effective strategy, is it durable? Is it sustainable over time? Especially with, as we talked about, political uncertainty, tax policy could change again if there's a regime change. So you have to really be mindful of a long-term plan versus, we just need some benefit in the next 3 to 5 years. Because as you scale, which I've seen, it is very hard to unwind and very costly as you get bigger.
Because tax, it sounds like taxes, your strategy can't just be something that you turn off and turn on. You can't just move IP to one country and then another country the next year. And obviously the policy uncertainty can be quite heavy. And so how do you think about those strategies? Sounds like it's increasingly becoming more and more of how you think about the strategy up front, given the long-term nature. Yep. So George, I want to ask you a little bit about that. One of the popular provisions that we get asked about in the class that we teach together is something that really motivates small businesses to start. So things like qualified small business stock, QSBS, that many of you may have heard of. And so I'm curious, when we think about provisions like that are really targeted to helping support small companies, companies to start and companies to grow, give quite generous tax incentives on the other side. How does a policymaker think about the trade-offs in putting them in place with, what the goal is relative to the revenue costs? Like how much revenue will that cost the country, especially given in this widening gap?
Yeah, I mean, you've heard us talk about the budget. You've heard us use words like the score of a provision, how much it'll raise or how much it costs. And that's because the budget estimates that are done for Congress when Congress is considering legislation drive so much of the answer as to what members of Congress are willing to do. I mean, a lot of the complexity of the tax code, I think, is driven by the need to hit a score. This provision can't cost more than $1 billion. So let's add 22 restrictions on how you can use it in order to get the estimate of the cost down to $1 billion, right? It's like, well, I mean, practitioners come along and they're like, why did they do it this way? Well, because they needed to get under $1 billion, not because they thought that's the right way to design a tax provision. Little bit of an aside. You mentioned, QSBS, qualified small business stock exemption, which is important to VC investors and startups. That's a good case study, I think, in how you trade off revenue and protecting the tax base versus policy goals, right? We know what the goal is. The goal is to encourage investment in startups. Startups bring innovation. They bring a lot of the new job creation and growth to the economy. And so there's a view that there's a worthy policy objective here. But good intentions, right? The road to somewhere really hot is paved with good intentions. That's not enough. With tax incentives, there's always this question of how much of that cost is windfall, giving people, giving businesses tax breaks for things they would have done anyway, right? You're not incentivizing new behavior, you're just giving them free money for something they were going to do anyway, versus that incentive actually moves the needle at the margin and leads to activity that would not have otherwise occurred. And that's a really hard empirical question. I think QSBS is a really good example of something that ought to be studied, right? The general capital gains rate for individuals is 23.8%. Is that too high for VC investors to give money to startups? QSBS takes it to 0. Does it need to go all the way to, if 23.8 is too high, what about 10? What about 12? Does it have to be 0? Do we have to lose all that revenue? Because it's a very expensive provision. I think repealing it would probably raise something in the neighborhood of $100 billion over 10 years, about a $10 billion a year revenue loss to the federal government, right? And I think I hear a lot of people say, people I've actually heard some people in the VC investor community say, I love it. I've never made a decision whether to invest based on it or not, but afterwards I get a tax break when I sell my stock. So I want to keep that. Of course I want to keep that. Does it go into my calculations to whether to invest? Nah, I don't look at that. So I've heard that anecdotally. I haven't seen like real academic research. Similar provisions where the same kind of question really needs to be examined. Opportunity zones. You can get capital gains exemptions. Again, good intentions. We want more capital going into disadvantaged communities to try to revitalize those communities. Is that actually happening, or are we just giving investors windfalls for investments they would have made anyway? These are always very tough questions, right? Because as I always say, the global economy is not a controlled experiment. It's really, you can't run a randomized controlled trial to try to answer these questions. And so a lot of research goes into it, but people still debate whether some of these things are effective or not.
So you're hitting on, like, we have some policies. It's unclear to actually, there could be some dead weight loss in the sense that we're giving companies or individuals some type of tax break for activity they may have done otherwise. So there's kind of on one side policymakers trying to balance how much we do that through the tax code. And then on the other side, it's also saying, well, we want to remain competitive in terms of subsidizing innovation. And so I want to bring in Elena to talk a little bit about that, because there are many places in the tax code that we motivate innovation through things like R&D credits, R&D deductions, et cetera. And so how do we think about what the U.S. does do relative to maybe other countries, and or thinking about R&D policy more generally as a tool to stay competitive in a place where China is just going crazy with their tax incentives for R&D.
Yeah, I think that's the exact right framing, and I'll actually borrow from George a little bit in that, with regards to the R&D tax credit, there's a lot of good economic evidence that credit is doing, on average, what we expect it to be doing, right? The social benefit of investment in R&D is higher than the private benefit, and so there's a good spending program case to be made for using federal dollars to invest in R&D. And I actually want to use the word spending on purpose. In the context of some corporate tax credits, they're bigger than tax policy. They're really just spending programs that are done through the tax code. I think a lot of the green energy credits fall into the same category, which is like the spillovers of investing in certain industries and certain activities benefit the economy. And so we want to induce corporations to do more than they would do if they were making that decision in private. So that's like the single firm argument for why, even in an ethos of we need corporate reform, we want a broad base and a low rate, there are still certain spending programs that I think will always stick around. And one of those includes tax credits for research and experimentation. There's also the international competitiveness angle that's incredibly important, both in the context of green energy technologies and R&E, which is U.S. manufacturers and U.S. companies are competing against foreign manufacturers and foreign companies that are benefiting from state spending in their industries. And so from an industrial policy standpoint, which is like a bad word amongst economists, we don't like to talk about industrial policy. It's really hard to do well. It's really easy to do very poorly. But when US companies are competing in a global economy where other state actors are engaging in industrial policy, it's hard to make the argument that we should be doing nothing, because the US companies are basically backpedaling from a very different place than other manufacturers and sort of innovative firms are. And so I think this is the crux of what's really complicated in sort of tax policy land right now, and the tax policy landscape is what the industrial policy posture should be of the United States, and how much of that should go through the tax code versus direct spending in response to what our trading partners are doing with their own domestic firms.
Very interesting. I'm going to switch gears because we cannot have a panel and not talk about AI today.
Oh, yes.
So of course, going to switch gears, and then I'm going to come back to the question of fair share at the very end for fun. And so I want to talk a little bit about how AI can potentially change or shape the tax landscape. Sorry, I'm going off the mic here, but I'll talk loudly as I do in class here. And so trying to think about ways that AI will introduce itself into the tax system or not. So this could be anything from tax tools that are used for compliance, to thinking about the fact that actually right now through the payroll tax system, we almost subsidize. We subsidize, I think, bots, you could say, because they're not subject to the payroll tax like an employee might be. And so then what do we do from a revenue perspective? The revenue story could get even worse the more that maybe we have fewer employees in lieu of AI. So very curious how the three of you think about that, both from a policy perspective. From you had an AI hack. I'm not sure if it was an AI hackathon today to come up with how to use AI in your own group. So curious your thoughts on that. Maybe Elena, we could start with you.
Yeah, I'll say one follow-up to, I think, the description you gave, which is spot on the description I hear all the time, that we're like subsidizing bots by not charging them the payroll tax. All I will say is, at a minimum, in the context of payroll tax, it is earmarked to Social Security. So if those bots aren't going to be pulling Social Security benefits later on, it's not obvious to me that they should be subject to a payroll tax unless you're also using the payroll tax for general fund purposes. So that's kind of my response when I hear that said a lot. I think about AI a lot in the context of the IRS. That's just given my background and given Secretary Bessent's proclivity to declare that it's okay to cut funding for the IRS because AI is going to solve everything, and so we don't really need people working at the IRS, which I think is possibly true. We have a $600 billion tax gap right now. They are clawing money back from enforcement at a time when the code continues to get more and more complex. And also they asked the IRS and Treasury to lift up a $5 trillion tax bill last summer with fewer people and fewer resources. So I don't think AI will be the panacea that Secretary Bessent likes to claim that it is. I think chronic funding of the IRS is a problem in the context of the revenue landscape that we talked about. We're not even collecting all the revenue we should be collecting right now, let alone layering in new taxes. And I would highlight from an AI perspective, as somebody who has worked with the tax data, like Becky and Juan Carlos, there are serious privacy concerns with letting AI into the IRS systems to begin with, that I think the IRS is still trying to figure out how to make sure taxpayer information is protected from outside bad actors. And that's without them really using AI at all. And so for me, from a practical standpoint, I can't imagine how we get to a place where IRS is using AI tools to do the things that I think are very reasonable, like, smart auditing, that some types of returns are going to be better candidates for auditing than others. You would imagine AI should be really good at figuring out how to do that. But that means you have to let AI into the systems and into the taxpayer data. And I think IRS needs money to figure out how to do that, and they don't have enough money to do the thing that they're doing right now, let alone modernizing and bringing AI tools in. So I worry about how we get to the equilibrium where AI is helping IRS, which clearly can be a good tool, but I think there's a lot of roadblocks along the way.
Yeah, operationally, I like what you talked about the IRS. I'm assuming at some point we're going to get to the point where tax is evaluated on a real-time basis versus after the fact, right? You file a return, you wait till statute expires, you hope you don't get audited. I think now you're going to start seeing, as soon as you transact, there's going to be someone watching. I'll give you an example. We transacted with a customer in a new country, very small country, not huge. Within 2 weeks, we got a notice. You need to be registered. You're transacting in our country. Very unlikely someone found that. It's got to be an AI bot, and we found out that country has implemented some AI. So it's really changed how fundamentally we need to operate, because now we need to report stuff as it happens versus reporting after it happened. The other piece, and you alluded to, so we at Webflow have done a huge movement towards AI functionally. So we all had to do AI projects and submit it to the company. But what we're seeing, especially for someone like myself, all these Excel manual driven processes are gone. It's all Excel driven. Claude, ChatGPT, whoever you use, where now I can spend more time on value creation, impact to the business. So I think you're going to see tax professionals literally become more like tax consultants versus doing the day-to-day operations in Excel, et cetera.
Which is a good thing.
A great thing. I love it. I love
I
it.
worked in a lot of Excel spreadsheets.
I love it.
So yeah, that's a good thing. George?
Yeah. But by the way, you mentioned the R&D credit as being an example of a very effective credit. One really interesting feature about the R&D credit, and I agree with you, is that it's an incremental credit. It was designed differently than almost any other incentive in the tax code. You don't get the credit for all of the R&D spend. You have to calculate a 3 year trailing average. And that gives you use a formula, and you only get the credit for spending above a formula based on your 3-year trailing average. So it's an interesting attempt by Congress to cut out some of the windfall for a base amount and try to better target it to the incremental additional R&D. On AI, I am just beginning to grapple with all this stuff, as many of us are. Becky, I think you highlighted flagged some of the issues that we need to be thinking about. I know a certain head of an AI company recently put out a paper with all these recommendations, and I haven't really had a chance to go through that in detail, but always welcome contributions to the dialogue. In my previous role, I have my own consulting firm now, but in my previous role as the EVP of Public Finance at Arnold Ventures, which is a philanthropy, which I just left in February. They're still a client. I'm a consultant to them. We were, and still are, a big funder of an organization called Stanford Reg Lab.
Yeah, of course. I work with them.
Which may be somewhere around here. I don't know. And
Their ED is here, so.
okay, great.
To the back. Yeah.
And so, they're a pretty big grantee of Arnold Ventures, and they do they continue to get their grant renewed, and they do really interesting work in using AI for tax compliance purposes. And, you can, everything from fraud and improper payments in the earned income tax credit, which is a refundable wage subsidy basically for low income workers, but which has like a 30% improper payment rate. A lot of that tends to be clustered in certain communities, which leads to the conclusion that there are unscrupulous tax preparers in certain communities, filing maybe fraudulent EITC claims, using AI to try to ferret that stuff out. To at the kind of the other end of the economic spectrum, complex multi-tiered partnerships like VC, hedge funds, private equity, where there's so much stuff going on, and the under-resourced individuals at the IRS just can't follow these complex org charts with 100 different entities, around the world, and using AI to try to sort out what's going on in these complex multi-tiered partnerships to see if there's tax avoidance going on. So I think, we're at the front edge of it, right? It's really interesting. My hope is that it'll become an important tool to make both to make tax compliance better and make sure people are paying the taxes they owe, but also to make life easier for the vast majority of honest taxpayers in doing their tax compliance.
Great, thank you. I want to ask about fair share, but I also want to give our audience time to ask questions. So I'm going to open it up to them, and then to the extent in the back of your mind, chew on a very short answer to what is your fair share of tax?
There's no short answer to that question.
I know. Which is why I'm going to open it up for questions here. So does anyone have any questions for our panelists? Felipe here.
I want to touch in a few points that the panel commented on. So Elena began talking about the dramatic deficit, the fiscal deficit gap in the U.S., and the perspective for this deficit really getting worse in the short run. And George mentioned the trade policy and all of the tariffs. So digging deeper in the interaction about those two things, I'm just curious to understand how much actually the tariffs contribute to reduce the fiscal deficit, like in terms of GDP? And how do you guys think policy-wise, if we want to have tariffs as a long-term policy tool for fiscal budget, how do you think about the adjustments of this? Like if other countries have any non-zero elasticity, you should expect some behavioral responses and people exporting less to the U.S. So how the projections look like when you think about tariffs long-term?
Yeah, I can jump in with a couple of the numbers. So the CBO in its most recent forecast, which I will note.
Michael?
Is my mic on? It was issued before the Supreme Court decision invalidated the IEEPA tariffs. And so ignoring the IEEPA tariffs, which are an enormous part of the effective base, the estimate was there would be $3.2 trillion in new tax revenue. CBO has to make very particular assumptions, and they don't have control over them, which is like the administration's policies are here, and they're going to be here for 10 years. And so other groups have more flexibility about what they can assume realistically, especially given the volatility of what turns on and turns off. So $3.2 trillion is kind of like a high watermark, assuming everything sticks around and including IEEPA. IEEPA being overturned reduces that number by 60%, because right now it's been replaced. And I didn't used to be able to rattle off all of these trade sections, but as George said, now suddenly in 2026, we're all experts in the trade acts of the 60s and 70s. So there was a section 122 Band-Aid that was put in place for 150 days that gave us 10% fraud rates on all countries. Okay, so that Band-Aid, with that Band-Aid in place, you claw back a little bit of the revenue. TPC estimates there's about $1 trillion in tax revenue currently with all the various policies that are going on. There are new Section 301 tariffs, which are these unfair trade practice tariffs that are under investigation right now through the U.S. Trade Representative. That's for unfair labor practices and excess manufacturing capacity. So there's 2 open 301 investigations with the promise of many more. And I guess like to layer onto that, I would say you shouldn't count out this administration and its ability to use Section 301 and Section 232 and these other trade acts to get back to the effective rates we were at before. You asked about the potential for tariffs to be contributing to sort of shoring up our fiscal crisis. You have to keep in mind, what are the tariffs supposed to be doing? I mean, I think we've been promised a lot of things that are in conflict with each other. One of them is it's going to revitalize U.S. manufacturing. That remains to be seen. You really need tariffs as permanent policy for any company to be considering taking a factory that's overseas and bringing it back to the United States. We're in such a volatile policy position right now, it's hard to imagine that somebody at a large company is going to make a substantial investment counting on permanence. So maybe not revitalizing manufacturing. Maybe it's going to raise revenue, but tariffs only raise revenue to the extent we continue importing. And at very high rates, as you noted, eventually global supply chains adjust so that we're not importing as much as we were before. And so if the goal is to, fix our trade balance and to get rid of imports, you're effectively mechanically eroding the tax base to be able to raise revenue to pay for things. So it's kind of a wishy-washy answer in that I don't think we know because we don't really know what stable tariff policy looks like. I completely agree with George that now that we have tariffs in place, it's going to be really hard for the next administration to come in and get rid of them from a revenue standpoint. Case in point, the Biden administration did not undo the tariffs of the Trump administration version 1. They were largely kept in place. So I think we're going to have tariffs on an ongoing basis. We are a huge net importer right now. So we import more than we export, which means there's potentially a substantial base to raise revenue. But if you want the base to stick around, you have to pick kind of a low tariff rate. The bigger is the rate, the less we import, and the more we erode the ability of tariffs to contribute to revenue at all.
Yeah, we're a net importer of goods. We're a net exporter of services, which tuck away for trivia night at the bar at some point. My sort of flippant answer to your first question about how much revenue was going to be, well, it depends on which day of the week we're having this conversation, right? Again, I mean, being agnostic on the policy of tariffs, right? Ideally, elite for certainty and planning purposes for businesses and investors, Congress would act and put a decision into statute, higher, lower, whatever. When one person can just wake up in the morning and change their mind, it freezes business planning. You can't plan on that, right? And so if they're going to be a major part of our revenue base going forward, putting aside whether I think they should be or not, it would be much preferred for Congress to step in and do it. The problem is that these days people want to get elected to Congress, but they don't. When they go there, they don't want to ever have to vote on anything. Mm-hmm. So they were happy to blame someone else for stuff, right? On the magnitude question, thinking about it in terms of like share of GDP, right? We've talked about a sustainable deficit, not debt to GDP, but deficit, the annual flow, not the stock number. Deficit to GDP is, a lot of people think about 3%. If 3% annual deficits, that's sustainable. We don't get into the death spiral. Right now, we're at about 6%, give or take. The tariffs, total tariffs, are, now I just went. Oh, that's a good idea. Okay. All right. Okay, here we go. The total tariffs, I think, are maybe around 1%. Well, before the Supreme Court case, around 1% of GDP. Now they're maybe less than half of that. But the president's promised to come back with more, even better, more beautiful tariffs. And so we may go back towards 1% of GDP. But whether it's 0.5%, 1%, if the fiscal gap that we need to close to get to sustainability is 3%, well, that's 0.5 to 1% is a material component of a 3% fiscal gap.
Let's take maybe one more, Kevin.
Thank you. Thank you all so much for being here, and professors for the extra credit. Great incentive. But Elena, I want to go back to earlier when you were speaking about how companies like Amazon and others allegedly don't pay tax every year, and you encouraged us to not hate the player, hate the game. I guess what I'm thinking about is the fact that many of these players spend like enormous sums of money to sort of like change the rules of the game by, lobbying state and federal authorities, Congress to architect a tax code that is most favorable to them. I guess given you and George have like worked in the halls of Congress, I'm wondering if you could talk a little bit about sort of the role of lobbying in resulting in the tax code that we have today.
And in light of our time, we're going to discuss lobbying briefly.
Yes,
if that's such a thing to do. So,
quick.
Yeah.
People and corporations with money lobby Congress. They always have. They always will. That's also part of the game that you may want to hate, and that's fine, but that's the game. My view on the corporate changes that have happened from 2017 to now is that they largely are, with some exception, in line with sort of good corporate tax policy, expensing and OB3. Most economists will tell you we like that that's like good bang for your buck in terms of incentivizing investment without foregoing so much revenue. So I see a lot of the gaming on the pass-through and individual side and a little bit less on the corporate side, where if I were picking the code I hate the least, I actually would say it's the corporate code, that we're not so far off what I wish it was.
Yeah, so I'll say a couple things quickly. One is the hate the player, not the game. I agree with that. I always say I don't blame the taxpayer. I blame the law. I mean, it's bad law, not bad taxpayers. A public corporation has a fiduciary responsibility to its shareholders to maximize profits. Right? If they don't do that, they get sued. There's a lot of the securities plaintiffs bar has people intentionally buy 10 shares of a company so they can watch that company like a hawk and then sue them for failing to do something to maximize profits. So I don't begrudge companies fulfilling their fiduciary responsibility. The problem is with the law. Now, I've been a corporate lobbyist. I will be again. I go in and out of that role throughout my career. It's sometimes called the revolving door. I will say, there is a lot of very sort of, to use an economist term, rent-seeking lobbying, special pleading. That absolutely exists. However, a lot of lobbying, despite the public perception, is providing invaluable information. I spent 15 years working on Capitol Hill. I'm a tax lawyer with an LLM in taxation, and a lot of experience in the private sector. When you're in Congress writing the law, you're in an ivory tower. You really are in an ivory tower. And you can make changes to the law that you think makes sense theoretically that can blow up business models without even realizing that you're going to do that. And the only way you can have that exposed before it's too late is to have those people come in and explain their business models to you and explain how the changes you're contemplating affect them. People on the Hill, on Capitol Hill, don't understand GAAP for the most part, generally accepted accounting principles, right? There is the old Section 199 in the code, domestic manufacturing deduction, was originally written as a lower corporate rate on domestic manufacturing. Why wouldn't you just do it as a lower rate on domestic manufacturing instead of a weird deduction? Well, companies came in, their lobbyists, corporate lobbyists came in and said, if you do it as a lower rate on our manufacturing income, a lower corporate rate means we're going to have to write down our deferred tax assets on our balance sheet. And if we write down our deferred tax assets on our balance sheet, that's going to trip debt covenants that we have. And our creditors are going to demand full repayment of our debt, right? So it was changed to a deduction. That only happens because of corporate lobbying. So that's an example. Like it's a complicated thing. Yes, there's rent seeking, but there's also that kind of communication that ensures better informed decisions by policymakers.
I think we are out of time. I'm so delighted we could end there because I wrote my dissertation on the 199 deduction, so I can't imagine a better way to wrap this up. Our panelists will be here if you have any follow-up questions, but please join me in giving them a huge thank you.